Companies in the S&P 500 are on pace to buy back more than $1 trillion worth of their own stock this year, a record high. Warren Buffett recently defended stock buybacks, or at least insisted that they're not always bad. But these companies are buying record amounts of their stock at a time when investors are largely selling their shares. I'm going to explain why companies are buying back their stock right now, what stock buybacks are and how they benefit corporations, and why this could be a risky gamble for some of the market's big names. Let's get into it. Goldman Sachs recently authorized $30 billion of planned stock buybacks, and Facebook parent Meta announced plans to buy $40 billion of their own stock. This might sound like an odd use of capital, given that these companies' stock prices have sunk and they've recently announced thousands of layoffs. Data show that both institutional investors and retail investors have been selling stock in recent weeks. But companies like to buy back stock during market sell-offs for a number of reasons. First, seeing the company buy signals to investors that management still sees the stock as attractive. It shows they're putting some skin in the game. Second, with growing uncertainty in the market, investors are saying buybacks are what they want. Bank of America's latest global fund manager survey shows the percentage of investors who want companies to return cash to shareholders is at the highest since 2017. Third, the latest earnings results show S&P 500 companies are generating lower net profits and seeing their pricing power decline. By purchasing their own stock, companies can improve their earnings per share numbers, making the stock more attractive to investors. When you calculate earnings per share, lower earnings don't look so bad if there are fewer shares. It's also important to note that top executives' pay packages are often tied to the company's stock price. So a higher stock price often means more money for CEOs and others who decide how to deploy a company's capital. But what are stock buybacks? And why do companies do them in the first place? When companies go public, they sell shares to anyone who wants them. When companies buy back their stock, they literally buy available shares from market makers or individual shareholders. Buybacks have historically increased the stock's price because, as our economics textbook teaches us, when supply decreases and demand stays the same, prices typically rise. But buybacks are not without their risks. Big companies like Meta and Goldman have lots of cash on their balance sheets, but others could run into some serious trouble. With interest rates rising, it will be much more expensive for companies to borrow money. Some firms could find themselves running out of cash while still needing to pay employees, vendors, and suppliers. That could create a cash crunch where companies have to sell off assets or declare bankruptcy. So when companies announce buybacks, some investors buy because it usually means the price will be rising. But some sell because it can also mean that the company is getting desperate and is more concerned with its stock price than with investing in the company itself. These CEOs may be following the advice of the late great Nipsey Hussle, who said in 2018, "I laid down the game for you, taught you how to charge more than what they paid for you, own the whole thing for you, reinvest, double up, then explain for you." That's all for now. See you next time.